Have you noticed the recent 3% rise in Vedanta's shares on December 14th? A day prior, Vedanta announced that its board would be considering and approving a second interim dividend for the fiscal year 24 on December 18th. This is not the first time Vedanta has done this. In May, the company declared its first interim dividend of 18.5 rupees per share, a move that was well received by the market. The promise of a second interim dividend, therefore, is being viewed as a positive step, a sign of the company's consistent performance and commitment to its shareholders. This is a clear demonstration of Vedanta's strategic approach to maintaining investor confidence and driving growth in its share value. This second interim dividend announcement has undoubtedly contributed to the recent rise in Vedanta's shares. But this isn't the first time Vedanta has made such a move. Let's take a walk down the memory lane and revisit the history of Vedanta's dividend outgo. It's a tale that unfolds over the course of 3 fiscal years, beginning in FY21. In FY21, Vedanta made a mark by paying out a total dividend of 3,519 crore rupees. Not a small number by any means, but as we'll see, it was merely a prelude to what was to come. Fast forward to FY22, the company took a significant leap, more than quadrupling its dividend outgo to a staggering 16,689 crore rupees. This was a clear sign of the company's growing confidence and commitment to rewarding its shareholders. Now let's proceed to FY23. The story here is even more remarkable. Vedanta's dividend outgo in this fiscal year skyrocketed to an astounding 37,572 crore rupees. That's more than twice the total amount paid out in the previous year, and a tenfold increase from FY21. This upward trajectory in Vedanta's dividend payouts is a testament to the company's financial strength and its dedication to shareholder value. However, it also raises some interesting questions about the sustainability of such a high dividend outgo and the future plans of the company. As you can see, Vedanta's dividend outgo has seen a considerable rise in recent years. And with the board considering a second interim dividend for FY24, the trend appears to be continuing. But as always, only time will tell how this unfolds. However, it hasn't been all smooth sailing for Vedanta. Recently, concerns have emerged about possible delays in refinancing the upcoming debt maturities of Vedanta's parent company, Vedanta Resources Limited, or VRL. These concerns have been further fueled by reports that VRL has secured $1.25 billion from private credit lenders for debt refinancing and a new credit facility. VRL is the holding company of the Vedanta Group, and this new fundraising effort is expected to help create a long-term sustainable capital structure. It also showcases VRL's continued ability to tap into global capital markets, reflecting investor confidence in the underlying business. VRL raised the loan from a group of reputable financial institutions to refinance existing liabilities, although the names of these lenders have not been disclosed. Yet, the credit rating agency, S&P Global Ratings, has downgraded VRL's rating. This downgrade was prompted by concerns about the extension of maturities of some of VRL's bonds. S&P Global cited the likelihood of a conventional default due to the company's large upcoming debt maturities and weakened access to both internal cash flow and external financing. VRL has approximately $4.5 billion in debt maturities through March 2025. These recent developments have raised some concerns about Vedanta's financial stability. So, where does this leave Vedanta now? After a recent 3% rise, the company's shares seem to be regaining their footing. However, it's important to remember that Vedanta's stock has stumbled nearly 20% this year, underperforming the benchmark Sensex, which rose by 15%. This comes in the wake of the company's ambitious fundraising efforts. Vedanta Resources secured $1.25 billion from private credit lenders, a step towards refinancing existing liabilities, but the road ahead isn't without its bumps. Vedanta faces debt maturities and concerns loom regarding potential delays in refinancing. The next couple of years will be crucial, with about $4.5 billion in debt maturities through March 2025. Yet, it's not all grim. The recent fundraising efforts demonstrate Vedanta's ability to tap into global capital markets, reflecting investor confidence in the underlying business. Despite the challenges, Vedanta continues to demonstrate its ability to access global capital markets, indicating a promising future.